2022 was a rocky year for investors. The S&P 500 ended the year with negative 18%, and Bitcoin was down over 50%. This naturally has a lot of people worried about what's going to happen in the near future, and investors are looking at the best possibilities for not losing as much in the years coming. A lot of companies have had to lay off their workers. Inflation is still at the highest levels in decades, and interest rates are rising. And the economy is expected to enter a recession sooner this year. How would Warren Buffett adapt to all these obstacles? That's what we're going to look at in this video. Make sure to watch the whole video for some important lessons that will help you in the future. Warren Buffett is one of the greatest investors of all time and CEO of Berkshire Hathaway. He is known for his value investing approach and long-term perspective. Often referred to as the Oracle of Omaha, he has consistently outperformed the stock market throughout his career. Here are 5 principles that Warren Buffett uses when investing in a tough market. Principle number 1. Using a market decline to your advantage. A stock market decline can be a buying opportunity for investors who follow a value investing approach, such as Warren Buffett. When the market declines, the prices of many stocks decrease, making them more attractive for purchase. This is because value investors look for companies that are undervalued and trading at a discount to their intrinsic value. A market decline can create opportunities to buy these companies at a lower price and then hold them for the long term in order to reap the benefits when the market recovers. Buffett has said that he likes when the price of a stock goes down and not up, because that means he can buy more of the company for a cheaper price. During a market decline, you can use various strategies to potentially benefit from the decrease in prices. Strategy number 1. Dollar cost averaging. Investing a fixed amount of money at regular intervals can help reduce the average cost of your investments over time and potentially benefit from lower prices. This is the best alternative for most people and the least time-consuming. Number 2. Value investing. Look for undervalued stocks that have strong fundamentals and have the potential to bounce back when the market improves. This is the approach Warren Buffett is taking. He is always on the lookout for these undervalued companies, and when he finds one, he holds the company for many years. Number 3. Short selling. Short selling is another way of making money during recessions and market downturns. Short selling means that you can sell stocks you do not own and then buy them back later at a lower price to make a profit. However, this strategy is complex and comes with significant risks. It's important to note that not all stocks will decline in a bear market. Some may even increase in value. Additionally, investors should consider their personal investment goals and risk tolerance before making any investment decisions during a market decline. Principle number 2. Only buy stocks in your circle of competence. Warren Buffett is known for his approach to only investing in businesses that he fully understands. He believes that investors should only invest in companies they understand and can evaluate the long-term potential of the business. Buffett says people should invest within their circle of competence. This means that investors should be able to understand the company's financial statements, industry trends, and management team. By only investing in businesses they understand, investors can make more informed investment decisions and have a better understanding of the risks and rewards associated with their investments. Additionally, by investing in businesses that they understand, investors can also better assess a company's competitive advantage and its ability to generate consistent earnings and cash flow. This is important because these are key indicators of a company's ability to generate returns for shareholders over the long term. However, it's important to note that it's impossible for an individual investor to understand every business and industry. In those cases, it's important to have a diversified portfolio. This way, you can have exposure to different industries and sectors and reduce the risk of having all your eggs in one basket. Principle number 3. Ignore market predictions and forecasts. Warren Buffett is known for his focus on long-term investing and his disregard for market predictions and forecasts. He believes that trying to predict market movements is a futile exercise and that investors should focus on the fundamentals of the companies they are investing in. He argues that market predictions are often based on short-term thinking and can be influenced by emotions and biases, making them unreliable indicators of future market performance. Instead, he focuses on analyzing the underlying value of a company and its ability to generate consistent earnings and cash flow over the long term. Furthermore, he also believes that by focusing on market predictions, investors are likely to be swayed by short-term fluctuations in the market and make impulsive, emotion-driven decisions. This can lead to buying high and selling low, which is the opposite of a sound investment strategy. Buffett also emphasizes the importance of having a long-term perspective and not getting caught up in short-term market fluctuations. He believes that by holding a portfolio of high-quality companies for the long term, investors will be better positioned to weather market downturns and ultimately generate higher returns over time. Principle number 4. Having a long-term outlook when investing. Warren Buffett is a strong advocate of having a long-term perspective when it comes to investing. He believes that by focusing on the long-term prospects of a company rather than the short-term market fluctuations, investors can make more informed and rational investment decisions. Buffett's investment philosophy is centered on the idea that the stock market is a mechanism for transferring money from the impatient to the patient. He believes that investors who are willing to hold onto their investments for the long term, rather than constantly trying to time the market, will be more likely to generate higher returns over time. Buffett also emphasizes the importance of having a long-term perspective when it comes to evaluating a company's performance. He looks for companies with strong fundamentals, such as consistent earnings and cash flow, and a competitive advantage in their industry. He believes that these companies are more likely to perform well over the long term, regardless of short-term market fluctuations. Furthermore, he also believes that having a long-term perspective allows investors to avoid the emotional mistakes that come with short-term thinking. This includes being swayed by market noise, panicking during market downturns, and getting caught up in market hype. In summary, Warren Buffett's investment philosophy stresses the importance of having a long-term perspective when it comes to investing. He believes that this approach allows investors to focus on the fundamentals of a company and make more rational investment decisions, ultimately leading to higher returns over time. Principle number 5. Diversifying your investments. Buffett has spoken extensively about diversification. He is often quoted as saying, "Diversification is protection against ignorance. It makes very little sense for those who know what they are doing." Buffett believes that if you have the knowledge and experience to make informed investment decisions, you don't need to diversify your portfolio as much as someone who doesn't have that knowledge. Instead, he recommends investing in what you know and understand and being willing to hold on to these investments for the long term. However, he also recognizes that not everyone has the time, resources, or expertise to analyze individual stocks and make informed investment decisions. For these people, he suggests a more diversified approach, such as investing in low-cost index funds that track the overall stock market. Overall, while Warren Buffett is not a fan of excessive diversification, he recognizes that it can be a valuable tool for many investors, particularly those who are less knowledgeable or experienced. Make sure to subscribe and watch the other videos on the channel for more investing and finance-related content. See you soon.